March 27th, 2002, 8:47 a.m. Manhattan, New York. John Rigas sits in his corner office at Adelphia Communications headquarters. The phone rings. It's his lawyer. The SEC wants to talk. Today. Outside his window, Adelphia's stock is collapsing, down 40% in 90 minutes. Investors are panicking. Cable customers are confused. Employees are terrified. Inside one filing cabinet, investigators will find something shocking. Documentation of $2.3 billion in hidden debt. Billion, with a B. Loans the company never disclosed. Money the Rigas family borrowed using Adelphia's name. Funds used to buy timberland, build a golf course, produce a film, even construct a private hockey rink. The family business John built from a single movie theater in small-town Pennsylvania had become one of America's largest cable companies. 6 million customers, $60 billion in market value. But it was built on a lie. A lie so big it destroyed retirement accounts, wiped out employee savings, and sent a father and son to federal prison. This is Adelphia Communications. This is what happens when a family business becomes a family piggy bank. But this isn't just about one corrupt family. If you had, in 2002, stock mutual funds in your retirement account, cable service from Adelphia savings in any market investment. This scandal helped trigger the second worst week in stock market history that year. The Dow fell 1,200 points in June 2002. Retirement accounts across America lost 15% of their value. $20 billion in shareholder wealth, gone, most of it. Ordinary people's savings in pension funds and 401s. Let me show you how a father taught his sons to steal and the warning signs investors missed for 3 years. But first, understand the pattern. This wasn't the first family-run fraud. Won't be the last. There's a pattern that repeats whenever families control public companies without oversight. Stage 1, build trust. Family creates successful business, earns community respect, becomes local heroes. Stage 2, go public. Family takes company public but keeps control, gets access to investor money while maintaining power. Stage 3, blur lines. Family starts treating public company money as personal money. Small loans become massive theft. Stage 4, hide reality. Family creates complex structures to hide theft, lies to auditors, pressures employees to stay quiet. Stage 5, collapse. Truth emerges, stock crashes, family faces criminal charges, ordinary investors lose everything. Tyco followed this pattern in 2002. CEO Dennis Kozlowski spent company money on personal art and parties. Convicted. Health South followed this in 2003. Founder Richard Scrushy inflated earnings by $2.7 billion to fund lavish lifestyle. Convicted. Rite Aid followed this in 1999. Executives inflated profits, used company funds personally. Multiple convictions, same pattern, different names. Same result, families steal, investors pay. In 1999, the Rigas family entered stage 3. Let me show you how it happened. To understand Adelphia, you need to understand cable television in America, and you need to understand the Rigas family. The industry. In the 1980s and 1990s, cable TV was a gold rush. Every home in America wanted cable. Companies raced to buy up local cable systems, build networks, connect communities. If you remember getting cable installed in the 80s or 90s, that explosive growth created massive opportunity and massive temptation. Cable companies needed billions to expand. They borrowed heavily, built infrastructure, bought competitors. Wall Street loved it. Debt was seen as good. You were investing in growth. This matters because it created cover for fraud. When everyone carries heavy debt, hiding extra debt becomes easier. The Rigas family. John Rigas started small. Born 1924 in Wellsville, New York. Greek immigrant parents, World War II veteran, bought a failing movie theater in Coudersport, Pennsylvania in 1952 for $72,000. Coudersport, population 2,800. If you've never heard of it, you're not alone. Tiny town in rural Pennsylvania. But John Rigas became its most important citizen. From that theater, he built a cable company. Started wiring Coudersport for cable in 1952. Expanded to nearby towns. By the 70s, Adelphia was the largest cable provider in rural Pennsylvania. John wasn't just a businessman, he was Coudersport's benefactor. Donated to schools, funded the hospital, built a new library, sponsored Little League teams. Everyone loved him. Think of him as the town's George Bailey from It's a Wonderful Life. Except this story ends very differently. The family structure. John had 5 children. 3 sons joined the business, Timothy, Michael, James. Daughter stayed out. This is critical. Adelphia became a family operation. Not just John's company. His sons ran major divisions. Family members filled executive positions. Family decisions, family control, family secrets. In 1986, Adelphia went public. This is stage 2 of the pattern. They sold stock to outside investors. raised capital, but the Rigas family kept control through special shares. John was chairman and CEO. Sons were executives, board of directors, mostly friends and business partners who trusted the family. They had investor money. But family control, the system that should protect investors. When a company goes public, rules protect investors. Companies must disclose all debts, must report executive compensation, must have independent auditors, review finances, must file quarterly reports with the SEC. The system assumes auditors will catch problems. Boards will ask tough questions. Regulators will investigate suspicious patterns. But the system has a fatal flaw. It assumes everyone acts in good faith. What happens when a respected family, beloved in their community, trusted by Wall Street, decides to lie? The 1990s expansion. Through the 90s, Adelphia grew explosively. Bought cable systems across America, Pennsylvania, Massachusetts, Florida, California, Virginia. By 1999, sixth largest cable company in America. 7 million customers. If you had cable in the 90s and lived in certain areas, Adelphia might have been your provider. Stock soared from $5 per share in 1990 to $87 per share in 1999. If you owned mutual funds with any cable stocks, and most retirement accounts did, you likely owned Adelphia shares. Wall Street analysts loved the company. Growth story, reliable cash flow, respected management, strong family values. That last part, strong family values, turned out to be true, just not the values anyone expected. The fatal flaw. Here's what nobody knew. Starting in the mid-1990s, the Rigas family began borrowing money using Adelphia's credit. Not for the company, for themselves. They created something called off-balance sheet entities. Think of them as side companies that borrowed money using Adelphia's guarantee but didn't show up in Adelphia's official financial reports. Legal? Technically, yes, if disclosed properly. But the Rigases didn't disclose them. Investors reading Adelphia's reports had no idea these loans existed. Why does this matter? If you're evaluating a company's health, you look at its debt. A company with $5 billion in debt is different from one with $7 billion in debt. Changes everything. Stock price, credit rating, investment safety. Adelphia's official reports showed manageable debt. The hidden reality, billions more. Borrowed by the family, guaranteed by the company shareholders were investing in. This is the setup. Stage 3, beginning. The Rigas family was about to cross a line they could never uncross. Part 1, the first temptation. Coudersport, Pennsylvania. John Rigas sits with his sons Timothy and Michael in the family conference room. Adelphia is growing fast, stock rising, respect increasing. But there's a problem, a personal one. The family wants to buy the Buffalo Sabres hockey team. Price, $92 million. John loves hockey. Timothy loves hockey. It's a passion project, a legacy purchase. The kind of thing wealthy families do. But here's the issue. Buying a hockey team with personal money means selling Adelphia stock. Selling triggers taxes, and it sends a signal to Wall Street. If the family is selling, maybe investors should too. They need the $92 million, but they don't want to sell shares. Someone, nobody will ever admit who, suggests an alternative. What if Adelphia guarantees a loan? The family borrows the money. Adelphia promises to pay if they can't. Family gets the team. No stock sale, no taxes, no signal to the market. One condition they don't tell investors: keep it off the books. It's family business, not company business. This was the moment when our company became our money. When public trust met private temptation, when a line was drawn and erased, they did it. Created a side entity, borrowed $92 million. Adelphia guaranteed it. Bought the Sabres. Investors? Never told. This was stage 3 beginning, but nobody knew it yet. Part 2, the escalation. Once you cross a line once, crossing it again gets easier. 1996 to 1997, more loans. Family wanted to buy more cable systems personally. Why? If they owned systems personally, they could sell them later at a profit without sharing gains with public shareholders. They borrowed $750 million, used Adelphia's credit, bought systems in their own names, 1998 to 1999, even more loans. Family wanted timberland, golf courses, Manhattan apartments, a production company to make films. Timothy Rigas bought a $3 million apartment on the Upper East Side. John bought land in Pennsylvania. Michael bought properties in Colorado, all financed with loans Adelphia guaranteed. By 1999, the hidden borrowing exceeded $1 billion. Let's be clear what this means. Public shareholders owned Adelphia. They invested in a cable company. They expected profits from cable service. Instead, the Rigas family was using the company's credit to build a private real estate empire, buy sports teams, and fund personal ventures. If you had Adelphia stock in your 401k in 1999, and hundreds of thousands of people did, your retirement money was being used to guarantee loans so the Rigas family could buy timberland. Think about that. Part 3. The lifestyle. By 2000, the scale was breathtaking. John Rigas was using Adelphia money for $13 million to produce a film about the Olympics, $3 million for a private golf course in Pennsylvania, $150 million for the Buffalo Sabres, $26 million for a hockey rink in Cootersport, population 2,800. Timothy Rigas expensed to Adelphia, $6.9 million for stock purchases and luxury goods. Company's $371,000 in personal country club dues, $2 million in apartment furnishings. The family even used Adelphia employees as personal servants. Company workers mowed John's lawn, built furniture for his homes, worked on his private properties, maintained family vacation homes, all on Adelphia's payroll, all billed to the company, all hidden from investors. One internal memo showed John's assistant ordering Adelphia carpenters to build a $2,000 sleigh bed for his granddaughter. Company time, company materials, company employees for a child's bed. Part 4. Warnings. Ignored. But somebody noticed. 1999. An Adelphia accountant named Karen Petrocelli raised questions. She saw transactions that didn't make sense. Money moving to entities she didn't recognize. Loans appearing on internal reports that weren't in public filings. She asked her supervisor, "Why aren't these disclosed?" Answer, "Family business. Don't worry about it." She persisted, went to the internal audit department, showed them the discrepancies. Response, "The Rigas family has built this company. They know what they're doing. Drop it." Karen Petrocelli had a choice: push further and risk her job, or stay quiet and keep her career. She stayed quiet. This is how it always works. The person who notices is never powerful enough to stop it. The people powerful enough to stop it are the ones doing it. 2000. Deloitte and Touche, Adelphia's auditor, noticed concerning patterns. Off-balance sheet entities were growing. Family transactions were increasing. They raised questions in meetings. The Rigases provided explanations, complex structures, tax planning, estate management, all legal. Deloitte accepted the answers. They were auditing numbers, not interrogating a respected family. This was the last chance to stop it before collapse became inevitable. Nobody stopped it. Let's do the math on what the Rigas family borrowed. Official Adelphia debt reported to investors, 2000, $3.5 billion. Hidden family debt guaranteed by Adelphia, 2000, $2.3 billion. Total actual debt, $5.8 billion. GAAP, $2.3 billion not disclosed. Where did that $2.3 billion go? $150 million. Buffalo Sabres purchased $26 million. Private hockey rink, $65 million. Personal stock investments, $371,000. Country club memberships, $13 million. Film production, $2 billion plus. Real estate, timberland, cable systems for family. The family was borrowing 66% more than investors knew. If you were evaluating Adelphia stock in 2000, you thought debt was manageable at $3.5 billion. Reality, $5.8 billion. Company was 66% more leveraged than disclosed. That changes everything. Stock valuation, credit risk, investment safety. They weren't just hiding pocket change. They were hiding a level of debt that, if known, would have tanked the stock immediately. Personal relevance. If you had mutual funds in 2000 investing in growth stocks or cable companies, you likely owned Adelphia shares. Those funds looked at Adelphia's debt ratio, seemed fine, investment grade. But that analysis was based on lies. Your fund manager was making decisions with false data. This is why disclosure rules exist. You can't make smart investments with fake numbers. The Rigases knew this. They hid the truth anyway. By 2001, they were at stage 4. Hiding reality was now essential for survival. Part 1. How the system worked. Let me explain exactly how money moved. This is important. Step 1. Family wants to borrow money for personal use. Ours, step 2. They create a side company called a partnership or entity controlled by family members personally. Step 3. That entity borrows from banks. But banks won't lend to a small entity without a guarantee. Step 4. Adelphia, the public company, signs as guarantor, meaning if family can't pay, Adelphia will. Step 5. Money goes to family, gets spent on hockey teams, real estate, personal luxuries. Step 6. Debt doesn't appear on Adelphia's balance sheet because technically Adelphia isn't the borrower, just the guarantor. Step 7. In footnotes of annual reports, there's a vague mention of related party transactions and co-borrowings. Language so complex, most investors skip it. Why did banks allow this? Because Adelphia's credit was good. The company had real assets, cable systems generating real cash. Banks got what they wanted, a reliable guarantee from a solid company. The losers? Public shareholders who didn't know their company was on the hook for billions in family debt. Part 2, the lifestyle escalation. By 2001, the spending was out of control. John Rigas maintained multiple homes, main residence in Coudersport apartment in New York City, vacation home in Cancun, Mexico, properties in Pennsylvania, farmland, all maintained by Adelphia employees. All utilities, landscaping, repairs billed to the company. While Timothy Rigas charged everything to Adelphia, $700,000 for his wedding reception, personal travel on the company jet, not disclosed, entertainment expenses that were actually family parties, even Christmas decorations for his home. One absurd detail that came out in court. Timothy expensed $12,000 to Adelphia for African mahogany flooring for his personal apartment. $12,000 for wood floors in his home, charged to a public company. The psychology here matters. When you start small, a lawn service here, a country club membership there, it normalizes. You convince yourself, I built this company, I deserve this. Then it escalates. If lawn service is okay, why not flooring? If flooring is okay, why not apartments? If apartments are okay, why not timberland? Each step seems like a small incremental change, but you end up somewhere unconscionable. John Rigas went from buying a movie theater in 1952 to stealing billions by 2001, 50 years. But the transformation from entrepreneur to criminal? That happened in just 5 or 6 years in the mid-90s. Historical context. If you remember the late 90s, dot-com boom, cable expansion, market euphoria, that era created this easy money, rising stock prices, lax oversight, auditors who trusted CEOs, boards that didn't ask hard questions, the same environment that created Enron, WorldCom, Tyco, Global Crossing. All of them collapsed between 2001 and 2002. All of them featured executives treating public companies as personal piggy banks. Adelphia was part of a wave, not unique, part of a systemic failure in American corporate governance. Let's calculate what the family took directly from Adelphia for personal expenses. Category: executive compensation. Normal CEO pay at similar-sized companies, $2,000, $5 to $10 million per year. John Rigas' official salary, $1.6 million. But additional payments to the Rigas family disguised as business expenses. Management fees to family entities, $252 million, 2000 to 2001. Consulting fees to family members, $44 million. Personal expense reimbursements, $174 million. Use of company aircraft for personal travel, estimated $30 million. Total compensation to family, official plus hidden, $500+ million over 2000 to 2001. That's not a salary, that's looting. For perspective, $500 million could have. Funded pensions for 10,000 Adelphia workers for a decade. Paid dividends to shareholders, reduced company debt by 15%. Instead, timberland, golf courses, hockey rinks, apartments. The family took money that belonged to shareholders, people with 401s, pension funds, college savings, and spent it on luxuries. Numbers don't lie. Part 1, First Warnings 2001. The market is changing. Dot-com bubble has burst. Stocks falling. Investors more cautious. Auditors more skeptical. In March 2001, Enron makes headlines. Accounting irregularities suspected. By December, Enron files bankruptcy. $63 billion in assets, gone. Shareholders wiped out. Wall Street is suddenly paying attention to off-balance sheet structures, the exact kind Adelphia was using. At Deloitte and Touche, Adelphia's auditor questions intensify. Audit team to Timothy Rigas? We need full documentation of all co-borrowing arrangements. Timothy provides some documents, not all. Explanations are vague. Internal email from Deloitte auditor, later revealed in court. I'm uncomfortable with the level of detail we're getting on these family transactions. Recommend we flag this for partner review. But Adelphia was a major client. Millions in audit fees. Nobody wants to lose a major client over questions that might have innocent explanations. Deloitte pushed, but not hard enough. Part 2. External pressure. May 2001. Arthur Anderson, Enron's auditor, under investigation. Congress is angry. Media is digging. Corporate fraud is front-page news. If you were watching news in 2001 to 2002, you remember this. Every week, another company under investigation. Trust in corporations collapsing. Adelphia's stock starts acting strangely. Heavy trading volume. Price volatility. Some investors are getting nervous. A Wall Street analyst at CIBC World Markets, Orrin Cohen, starts asking questions. He looks at Adelphia's debt levels, notices footnotes about co-borrowings with family entities. He calls Timothy Rigas. Can you clarify these co-borrowing amounts? Timothy's response, It's complicated family estate planning, nothing to worry about. Orrin isn't satisfied. He downgrades Adelphia's stock from buy to hold. Small move, but it's a warning shot. March 2002. The SEC sends Adelphia a letter. Routine inquiry. They want information about those co-borrowing arrangements mentioned in footnotes. The Rigas family knows if they provide full information, the truth comes out. They have two choices. Come clean, disclose everything, face consequences. Stall, provide partial information. Hope it blows over. They choose option 2, fatal mistake. Part 3, internal panic. Inside Adelphia headquarters, employees who know the truth are terrified. Karen Petrocelli, the accountant who questioned things back in 1999, sees the SEC letter. She thinks, this is it, it's finally coming out. Other finance employees start updating resumes. They know what happens when the SEC investigates. The company might survive, but most employees won't. Adelphia's stock is now $20 per share, down from $87 in 1999. But it's about to get much worse. John Rigas, now 77 years old, is still in denial. He tells the board, this is all blown out of proportion. We'll clarify things and move on. But Timothy knows better. He starts consulting criminal defense attorneys. Lawyers tell him, if they find what we think they'll find, you're looking at federal charges. Timeline tightening. March 14th, 2002. SEC requests information. March 20th, 2002. Adelphia delays response. March 25th, 2002. Board demands answers from John and Timothy. March 26th, 2002. Family admits off balance. Sheet debt is $2.3 billion. Board members are shocked. Most had no idea. They thought they were overseeing a legitimate cable company. March 27th, 2002. The day we started this story, Adelphia is required to disclose. They file a notice with the SEC. Previous financial statements may have materially understated certain liabilities. Translation, we lied about billions in debt. Part 4, final hours, March 27th, 2002. Markets open. Adelphia stock, $16 per share. By 10 a.m., $12 per share. By noon, $8 per share. By market close, $4 per share, 75% loss in one day. If you had $10,000 in Adelphia stock at market open, you had $2,500 by market close. If you were 65 years old with Adelphia in your retirement account, you just lost 75% of that portion of your savings. In one day, $20 billion in shareholder value erased. The phone call John received that morning from his lawyer, that was the beginning of the end. By evening, the family was meeting with criminal defense attorneys. By week's end, the board would force John and Timothy to resign. By month's end, federal prosecutors would begin building a case. The machine was breaking. Stage 5 was beginning, and there was no stopping it. Personal relevance. If you were watching your 401k balance in March 2002, you saw drops. Not just Adelphia, the whole market fell. Why? Because Adelphia was the fourth major accounting scandal in 6 months. Enron, December 2001. Tyco, January 2002. WorldCom, March 2002. Adelphia, March 2002. Investors lost confidence in all corporations. If these giants could lie, who else was lying? The S&P 500 fell 14% between March and July 2002. Everyone's retirement accounts took hits. The corrupt Rigas family didn't just hurt their own shareholders. They contributed to a market-wide collapse that hurt millions of Americans. Part 1. The trigger. March 27th, 2002, 4:15 p.m. Trading closes. Adelphia stock, $4.23 per share, down 75% in one day. But the real collapse is just beginning. March 28th, Moody's downgrades Adelphia's credit rating to junk. Means banks can call in loans. Creditors can demand payment. Adelphia owes $3.5 billion in disclosed debt, plus $2.3 billion in hidden family debt. Total, $5.8 billion. Annual revenue, $3.6 billion. Math doesn't work. Company can't pay. Within 48 hours, banks freeze Adelphia's credit lines. No more borrowing, no more flexibility. Part 2, the Cascade Hour. 0 on March 27th, 4 p.m. Stock crashes 24 hours later. Credit downgrade 48 hours later. Banks freeze credit 72 hours later. Vendors demand cash payment, no more credit terms. 1 week later, board fires John Rigas as CEO, Timothy Rigas as CFO. 2 weeks later, company announces it cannot make debt payments. 3 weeks later, NASDAQ delists Adelphia stock, too low to trade on major exchange. 2 months later, June 25th, 2002, Adelphia files. Chapter 11. Bankruptcy. The 6th largest cable company in America. 6 million customers. 20,000 employees. Bankrupt. Part 3, human cost. Meet James Brown, not his real name, but his story is real. James worked at Adelphia for 18 years, started as a cable installer in 1984, worked his way up to regional manager, 54 years old in 2002. His retirement account, heavily invested in Adelphia stock. Why? Company encouraged it, matched contributions if you bought company stock. At the peak in 1999, James had $340,000 in his 401k, most of it in Adelphia shares at $87 each. By April 2002, that $340,000 was worth $31,000. He was 11 years from retirement, had planned to retire at 65 with enough to live comfortably. Now, he'd have to work into his 70s, maybe longer. His comment to reporters, "I trusted them. John Rigas seemed like a good man. I never imagined..." James wasn't unique. Thousands of Adelphia employees lost retirement savings. But it gets worse. Total job losses. When Adelphia declared bankruptcy, immediate layoffs, 2,100 employees, additional cuts over next year, 3,400 employees. Contractors and vendors who depended on Adelphia, estimated 5,000 plus more jobs, 10,000 jobs, gone. People who did nothing wrong, cable installers, customer service reps, accountants, engineers, all paying the price for the Rigas family's theft. Shareholder losses. At peak market cap, 1999, $60 billion in bankruptcy, 2002, $0. Total shareholder losses, $60 billion. Who were these shareholders? Public pension funds, teachers, firefighters, government workers, private 401k accounts, ordinary workers, mutual funds, anyone with retirement savings invested in growth stocks. Individual investors, people who bought shares directly. Most had no idea the Rigas family was looting the company. They trusted the financial statements, believed the auditors, assumed the system worked. They were wrong. Part 4, the raids. May 2002, FBI raids. Adelphia headquarters in Coudersport. Agent seize 50 filing cabinets of documents, computer hard drives, email servers, personal files from Rigas family offices. What they find is stunning. Documentation of $252 million in management fees paid to family entities, evidence of company funds used for personal expenses, internal emails showing family members knew the disclosure was inadequate, bank statements showing money flow from Adelphia to personal accounts. One email from Timothy Rigas to his father, March 2002. "We need to get our story straight before talking to auditors. Some of these transactions will be hard to explain." That email becomes Exhibit A in the federal case. Let's count the final damage. Direct shareholder losses, $60 billion, market cap to zero. Employee 401k losses, estimated $1.2 billion, most had company stock. Creditor losses in bankruptcy, $2.1 billion, banks and bondholders who couldn't collect. Vendor losses, $400 million, companies owed money by Adelphia. Total economic damage, $63.7 billion. Put that in perspective, more than the GDP of 120 countries. Enough to fund Social Security for 2 months, equal to building 400 new hospitals, equivalent to full college tuition for 2.5 million students. One family, one company, $63, $7 billion in damage. And here's what's sickening. The Rigas family took, directly for personal use, maybe $500 million to $1 billion over the years. They destroyed $63.7 billion to steal less than $1 billion. The damage was 63 times larger than the theft. Part 5. Arrests. July 24th, 2002. 6:15 a.m. FBI agents knock on John Rigas' door in New York City. He's 78 years old. "John Rigas, you're under arrest for securities fraud, bank fraud, and conspiracy." He's led out in handcuffs. Cameras everywhere. The man who was Coudersport's hero is now America's villain. Same morning, Timothy Rigas arrested, Michael Rigas arrested, 2 other executives arrested. Charges: securities fraud, lying to investors, bank fraud, false statements to lenders, conspiracy, working together to commit crimes. Maximum sentence if convicted on all counts, 20 years in federal prison. The Rigas family, 1 month earlier, worth hundreds of millions, now facing decades in prison. Stage 5 complete. The collapse, total. Part 1. The trial. The trial began March 2004, nearly 2 years after the collapse. Prosecutors presented the case methodically. Evidence shown to jury, 252 transactions where Adelphia funds went to family. Email showing John Rigas approving personal expenses charged to company bank records of $174 million in expense reimbursements to family testimony from Adelphia accountants who were told to hide transactions. The defense argued John and Timothy truly believed the transactions were legal. They thought family and company were intertwined. No criminal intent. Jury didn't buy it. July 8th, 2004. Verdict: John Rigas, guilty on 15 of 17 counts. Timothy Rigas, guilty on all 18 counts. Michael Rigas and another executive, acquitted. Jury found them less involved. Sentencing came in 2005. John Rigas, 15 years in federal prison, age 80 at sentencing. Timothy Rigas, 20 years in federal prison, age 49 at sentencing. For John, at age 80, this was effectively a life sentence. For Timothy, he'd be nearly 70 when released. Part 2. Other players. The auditors, Deloitte and Touche, settled with shareholders for $167 million, admitted no wrongdoing but paid for missing the fraud. Board members, most claimed they didn't know. Some likely didn't. But they failed in their duty to ask tough questions. Several board members faced shareholder lawsuits. Most settled personally for undisclosed amounts. The bankers who loaned money based on Adelphia's guarantees, they eventually recovered some funds in bankruptcy, but lost billions overall. Nobody else went to prison, just John and Timothy. Part 3. Bankruptcy and recovery. Adelphia remained in bankruptcy for nearly 5 years. During that time, assets sold, cable systems sold to Time, Warner and Comcast for $17.6 billion, 2006. Buffalo Sabres sold for $92 million, what family paid for it. Real estate holdings liquidated creditor recovery. Banks and bondholders owed $5.8 billion, ultimately recovered about $3.1 billion. Recovery rate, 53 cents on the dollar. Better than most bankruptcies, but still $2.7 billion in permanent losses. Shareholder recovery, common shareholders, people who owned stock, recovered zero. Nothing. If you had $10,000 in Adelphia shares in 1999, worth $0 after bankruptcy finalized, total wipeout. Part 4. Where are they now? John Rigas, released to home confinement in 2016 due to health, age 91, died in 2021 at age 96. Spent 12 years, total imprisoned or confined. Timothy Rigas, released in 2019 after serving 17 years, now in his mid-60s, forbidden from serving as officer or director of any public company. Michael Rigas, acquitted at trial, returned to private life, avoided prison. James Brown, the employee we mentioned, worked until age 70. Never fully recovered his retirement savings. The comfortable retirement he planned never happened. Adelphia employees, most found new jobs eventually, but many lost seniority, pensions, career trajectories. Some never recovered financially. Cootersport, Pennsylvania, population still around 2,500. The library John Rigas built still stands, his name removed from buildings. Town economically depressed after losing its biggest employer. The Rigas family went from local heroes to national criminals. Their name is now synonymous with corporate fraud. Personal relevance. If this sounds familiar, because you remember 2008 financial crisis bailouts, the pattern is similar. People who caused Adelphia collapse. John Rigas, 15 years prison. Timothy Rigas, 20 years prison. People who paid for it. Ordinary employees, lost jobs, lost retirement savings. Shareholders, lost everything. Taxpayers, indirectly, market crash affecting overall economy. The people who did nothing wrong paid the highest price. Same pattern in every major corporate fraud. So what does Adelphia teach? Not just about one corrupt family, about trust, about oversight, about systems that are supposed to protect ordinary people's savings. Lesson 1. Family control without oversight creates temptation. Adelphia's fatal flaw: a family controlled a public company with minimal independent oversight. The board was mostly friends and local business partners. They trusted John, assumed good intentions. But here's what history shows. Whenever families control public companies without strong independent boards, risk increases. Examples. Adelphia, 2002. Rigas family looted $2.3 billion. Hollinger International, 2003. Conrad Black family used company as piggy bank. Stole $400 million. Rite Aid, 1999. CEO family members enriched themselves. $1.6 billion fraud. Pattern repeats. If you have investments in family-controlled companies, and many do through mutual funds, watch for red flags, board dominated by family members or longtime friends, not truly independent, vague disclosure about related party transactions in footnotes, complex corporate structures that are hard to understand, family members receiving fees from multiple entities, resistance to questions about family compensation. What to watch? If annual reports show management fees paid to family entities, ask why. If company has subsidiaries or partnerships with vague purposes, be skeptical. Trust must be verified by transparency, not earned by reputation. John Rigas was beloved in Cootersport for 50 years. Didn't stop him from stealing billions. Lesson 2. Off-balance sheet structures are red flags. Adelphia hid debt through co-borrowing arrangements and off-balance sheet entities. Sound familiar? Same technique that destroyed. Enron, 2001. SPVs, special purpose vehicles, hid billions in debt. Parmalat, 2003. Off-balance sheet entities disguised $14 billion whole Lehman Brothers, 2008. Repo, 105 transactions, moved $50 billion off books before collapse. Why do companies use off-balance sheet structures? Sometimes legitimate, separating risky ventures from main business, but often hiding problems. The rule: if you're reading a company's annual report and see complex structures with vague explanations, be very careful. Footnotes matter. Companies hide crimes in footnotes. From Adelphia's 2000 annual report, footnote 12, the company has guaranteed certain debt obligations of affiliated entities owned by the Rigas family. That footnote represented $2.3 billion in hidden risk. Most investors never read it. Those who did couldn't calculate the amount. Adelphia's lessons for investors: read footnotes about related party transactions. Question any guarantees of debt for family entities. Be skeptical of companies where executives control side businesses using company resources. If disclosure is confusing, assume there's a reason. Complexity is often camouflage for fraud. Lesson 3. Auditors have conflicts that undermine independence. Deloitte and Touche audited Adelphia for years. They should have caught this. They asked some questions, but not hard enough. Why? Adelphia paid Deloitte millions annually. Losing that client meant lost revenue. Same problem in Enron. Arthur Andersen earned $52 million from Enron, audit plus consulting. Didn't want to lose the client, WorldCom. Arthur Andersen again missed $11 billion fraud Parmalat. Deloitte and Grant Thornton both missed $14 billion fraud pattern. When auditors make millions from a client, incentive to keep client happy often outweighs duty to investors. After Enron and Adelphia, Congress passed Sarbanes-Oxley Act, 2002. New rules. Auditors can't provide certain consulting services to audit clients. CEO and CFO must personally certify financial statements. Criminal penalties for destroying documents. Better, but not perfect, because fundamental conflict remains. Companies pay auditors. Auditors are supposed to protect investors. Can't serve two masters perfectly. What changed after? Adelphia. Stricter rules on related party disclosures. More scrutiny of family-controlled public companies. Greater criminal penalties for executives who lie. Faster delisting of companies with accounting problems. But incentives that create fraud still exist. This pattern isn't finished. Right now, 2025, family-controlled public companies still common, especially in Asia and Europe. Off-balance sheet structures still legal. If properly disclosed, private equity and complex corporate structures make oversight harder. Watch for family-controlled SPACs, special purpose acquisition companies, showing vague use of funds. International companies with U.S. listings where regulatory oversight is weaker. Private equity-backed companies going public with complex structures. If pattern holds, and it always does, we'll see another major family-controlled company fraud by 2026 to 2027. Watch for these warning signs. Delayed financial reports from family-controlled companies, stage 3. Vague explanations for related party transactions, growing rapidly, stage 3. Executive compensation that seems excessive relative to performance, stage 4. Auditor changes without clear explanation, stage 4 critical. Historical precedent. Adelphia, first questions. 2001. Collapse 2002. Gap 1 to 2 years. Parmalat, first questions 2002. Collapse 2003. Gap 1 year. Satyam, India, first questions 2008. Collapse 2009. Gap 1 year. Timeline rarely changes, only names. I'm watching several family-controlled companies in emerging markets showing delayed reports and unusual related party transactions. If 3 or more delay annual reports past 6 months, we're at stage 3. Do the math. Here's the uncomfortable truth. The system that enabled Adelphia hasn't fundamentally changed. Family-controlled companies still exist. Boards still trust respected executives too much. Auditors still have conflicts of interest. Regulators still arrive too late. Different country, different name, same playbook. The pattern says this will happen again because the incentives that created Adelphia concentrated power with minimal oversight. Those incentives remain. March 27th, 2002, 8:47 a.m. John Rigas sits in his office. The phone rings. His lawyer. The SEC wants answers. Outside, his empire is collapsing. Inside, he knows the truth is about to emerge. 50 years building, 6 years stealing, one day collapsing. His father was a Greek immigrant who taught him, work hard, stay honest, build something good. John listened to the first part. Built Adelphia from one movie theater to sixth largest cable company in America, but forgot the second part. Took what wasn't his, used public company funds for a private luxury, taught his sons to do the same. In the end, 15 years in prison. Released at 91 only because he was dying. Name destroyed. Legacy ruined. Timothy, his son, spent 17 years in federal prison. Released at 65. The prime years of his life gone. Both could have retired as respected businessmen. John could have died a hero in countersport. Instead, they're remembered as criminals. But here's what nobody wants to admit. The system that created Adelphia still operates. Family-controlled public companies still exist with minimal oversight. Complex structures still hide truth. Boards still trust too much. The next Rigas family is already in position. Different names, different companies, same playbook. I'll be watching companies with these combinations. Family control over 40%. Complex related party transactions growing. Board dominated by longtime associates. If I see rapid growth in management fees to family entities plus delayed disclosure, that's stage 3. History says family-controlled frauds appear every 5 to 7 years in U.S. markets. Last major one, 2014, China-based but U.S. listed. That was 11 years ago. Pattern says we're due, because it will happen, always does. The Rigas family stole billions, but they taught us something valuable. Watch the footnotes, question complexity, verify trust. The warning signs are always there. 2 years before collapse. We just need to pay attention.